Welcome to Inside the Economist's Mind, where this week, starting June 2nd, 2025, we unpack the shifting dynamics of population growth, monetary policy caution in New Zealand, and what to watch in the global economic calendar. Think of this as getting the essential insights from the material we've dug into today without you having to wade through it all yourself.
Exactly. The analysis we've reviewed, it gives us a really sharp snapshot of the current economic moment. It highlights recent data points, looks at a crucial policy decision, and yeah, definitely reinforces this ongoing theme of uncertainty dominating the global outlook right now. It provides the specific details that help us, connect the dots.
So let's jump straight into our first major theme, Australia's population growth. Now, you'd often think demographics move at a pretty predictable, even, well, glacial pace, right? But the material we've been through shows that's not always the case, especially when you look at the period since the pandemic, and there's been a surprising and perhaps surprisingly fast shift here.
Yeah, what's particularly striking is how population growth is slowing down quicker than many expected, even faster, perhaps, than some leading indicators had suggested not too long ago. We saw it peak just above, what is it, 2.5% year-on-year back in Q3 2023. But by the September quarter of 2024, it was already down to 1.8%. Looking ahead, forecasts are now settling around 1.7% for both 2024 and 2025. And to put that in perspective, that's actually a slower pace than the average we were seeing back in the 2010s.
Wow, 1.7%. That's quite a downswing in a relatively short time. What do we understand about why the slowdown is happening faster than anticipated? What are the drivers behind this surprising pace?
Well, look, part of it was anticipated. We had that big catch-up effect after borders reopened, students, permanent residents whose arrivals were delayed, suddenly coming in. That created a surge. But the speed at which that surge is unwinding, that's the surprise. The analysis points to potential factors like processing delays for certain visa categories, and interestingly, possibly an increase in long-term non-permanent residents who are now choosing to depart.
Right, departures. And here's where it gets really nuanced and frankly quite fascinating. The material mentions a divergence that opened up between total population growth and growth in the working age population, that's people aged 15 and over. For a while, that gap was wider than usual, skewed towards adults, which, well, made perfect sense with that surge of students and residents arriving. But as that post-reopening surge unwinds, that gap is now narrowing. Though a written detail from the labor force survey suggests the decline in working-age population growth might have become a little less steep just recently. Bit of noise there, maybe.
Could be. And this raises a crucial point. Why does this shift in population dynamics matter to you listening? Well, slower population growth has direct implications for key parts of the economy. In the labor market, for instance, it means employment doesn't have to grow quite as strongly just to keep pace with the available pool of workers.
Makes sense.
And in the housing market, less underlying demand pressure from new arrivals is likely contributing to a slowdown in rent inflation, which we've certainly seen reflected in the data.
And this isn't just a national phenomenon playing out evenly across the board, is it? The analysis highlights pretty significant state-level variations.
That's right. Some states, like Western Australia, Victoria, Queensland, they saw growth running ahead of the national pace. Meanwhile, New South Wales lagged behind, partly because more people were moving out of the state than into it. That's negative interstate migration.
It really underscores how quickly these demographic dynamics can shift, not just across borders, but even within a country. Fascinating stuff. Okay, that surprising population story sets an interesting stage. Let's transition now, shift gears a bit, and move across the Tasman to New Zealand. We're looking at the Reserve Bank of New Zealand's latest move on monetary policy.
Right. So as widely expected, the RBNZ did cut their main interest rate, the official cash rate, or OCR. They cut it by 25 basis points. That's a quarter of a percentage point, bringing it down to 3.25%. However, the material we reviewed highlights what's described as a surprising amount of caution accompanying that decision.
That surprising caution bit is exactly what caught my eye, too. I mean,
Yeah.
what makes a rate cut that was largely expected? What makes it cautious?
Well, the key detail here is that it wasn't a unanimous decision. It was actually a split vote within the Monetary Policy Committee. 5 members voted for the cut, okay, but 1 member voted to hold steady.
Hold steady. Interesting.
Yeah, and this is actually only the second time we've seen a split vote like this since the committee structure was introduced. Apparently, that dissenting member wanted more time to see inflation expectations firmly consolidated and to get a clearer picture of the current uncertainty in the economic outlook before making a move.
So even within the room where the decision is made, there are differing views on the right timing for this cut.
Exactly. And the governor, Adrian Hawksby, He commented that the split was about the timing of this particular cut, not necessarily about the overall medium-term path for the OCR. Now, the RBNZ's new projection does show a lower low point for the OCR than they previously forecast, thinking 2.85% compared to 3.0% before. But critically, their projection now implies the next cut is more likely to happen in August rather than July.
Ah, so pushing it out a bit.
Precisely. And the governor explicitly stated there's no bias leaning towards a cut at the July meeting. So while they've started the cutting cycle, they've basically signaled they're going to be very much data dependent from here on out, watching closely.
Okay. Looking ahead then, what's the RBNZ's broader forecast for the New Zealand economy being on? What other changes did they make?
Well, they've notably lowered their near-term forecasts for GDP growth. For instance, they're now projecting just 1.8% annual growth for 2025.
1.8%. What was it before?
It was 2.4% back in their February forecasts, so quite a downgrade.
Yeah, significant.
And a big reason cited for this downgrade is a weaker global outlook, partly attributed to increased trade protectionism around the world. On inflation, they expect it to peak relatively soon, maybe 2.7% in the third quarter of this year, and then dip just below their target to 1.9% by early 2026.
That theme of uncertainty just keeps cropping up, doesn't it? In the analysis we've seen, uncertainty is the only constant. One phrase put it quite starkly. How does the RBNZ factor this kind of uncertainty into their thinking?
They describe the risks they face as heightened. And a big part of their uncertainty, it seems, is grappling with how global trade shocks like tariffs and protectionism will ultimately impact their economy. Will these shocks be disinflationary? Meaning, do they act like a net negative demand shock that slows things down and lowers prices?
Or the opposite?
Or could they be inflationary if they disrupt supply chains and push costs up a net negative supply shock? It's a real puzzle. The analysis notes that the RBNZ even published alternative scenarios in their statement to reflect this uncertainty. They modeled a downside demand scenario that could see the OCR go as low as 2.55%.
Wow.
And the supply shock scenario where they might even have to hike rates later, maybe up to 3.5%.
Hike. So cutting now but potentially hiking later, that really speaks to the uncertainty?
It does. And what's interesting is they didn't really explore a scenario where the impact of these trade frictions turns out to be less severe. They basically signaled that seeing concrete evidence of how things like U.S. tariffs are actually affecting New Zealand businesses and households will be crucial for their future policy path. Very much wait and see.
Okay, that gives us a great handle on the recent data and policy decisions in Australia and New Zealand framed by this pervasive backdrop of uncertainty. Now, let's shift gears completely and look at what's on the economic calendar for this week, starting June 2nd, 2025. There's quite a bit to watch globally and closer to home.
Yes, it's a packed week for major economic data releases from around the world. We're looking at things like the critical U.S. non-farm payrolls and ISM surveys.
Always important.
Absolutely. Then there's important Euro area consumer price index data, the CPI, the main measure of inflation, and the European Central Bank's policy decision. Plus, China's Caixin PMIs, which give us an early look at manufacturing and services activity there.
Okay, lots happening globally. What should we be keeping an eye on specifically for Australia this week?
Right. Domestically, the biggest release is the first quarter GDP data, the measure of the total value of goods and services produced. The forecast we've seen is for 0.4% quarterly growth.
0.4.
Okay. We'll also get several partial indicators leading up to that, things like company profits, inventories, the trade balance, and household spending indicators.
Yep.
Plus, the minutes from the Reserve Bank of Australia's May meeting and a speech from the RBA's Assistant Governor for Economic Affairs are due as well. Could be some useful insights there.
And across the Tasman in New Zealand, anything major?
For New Zealand, the key data points on the calendar include the terms of trade, which is essentially that ratio of export prices to import prices, telling us about national income from trade.
Right.
Plus, commodity prices and building work data are also out.
Okay, so a lot of data points coming out. Out of all those releases, globally and domestically, are there any that particularly stand out? Maybe in terms of potential to move markets or give us key insights into these themes we've been discussing, like uncertainty or trade impacts?
Yeah, definitely. Based on the rundown of the calendar, a few really catch the eye. First, the U.S. employment report payrolls, unemployment rate.
Yeah.
It's the monthly snapshot of the U.S. labor market. Even with global uncertainty, the baseline expectation is still for a reasonably healthy report, but this one always has the potential for significant revisions and surprises.
Always want to watch.
Then, the Euro ECB policy decision. A rate cut of 25 basis points from the European Central Bank seems almost fully baked in by the market. So the real focus will be on their forward guidance and any new economic projections they release. What comes next?
Well, yeah.
Australia's Q1 GDP. That 0.4% forecast suggests easing growth. The analysis suggests it was partly impacted by things like natural disasters late in the quarter, but potentially offset by external demand being brought forward maybe ahead of anticipated tariffs.
Yeah.
Interestingly, net exports are actually expected to add to GDP growth in Q1,
So trade helping there, for now at least.
for now, which leads to Australia's April goods trade balance. It's expected to widen further, driven by stronger exports, including a recovery in agricultural exports. However, the analysis does point out that exports to the U.S. specifically might start showing pressure from those tariffs we mentioned earlier. Something to watch.
Definitely. What about spending?
Australia's April household spending. Expected to be another soft month. The forecast is actually for a decline, minus 0.2%. Partly due to holiday disruptions, the timing of Easter and ANZAC Day holidays impacting spending patterns.
Right, seasonal noise again.
And finally, New Zealand terms of trade. Forecast for a really significant rise over 6%, mainly driven by a strong lift in commodity export prices. This is important because it directly impacts New Zealand's national income.
Okay.
And look, all these pieces of data, they're arriving into that environment. The analysis characterized as learning to live with uncertainty, an environment really heavily influenced by global trade dynamics and how central banks and governments are responding.
So wrapping up, we've seen how population dynamics aren't always the slow-moving train we might assume, shifting surprisingly quickly in Australia. We've unpacked the cautious stance from the RBNZ, even as they made an anticipated rate cut, reflecting this deep uncertainty, especially around trade impacts. And we've highlighted a pretty busy week ahead on the economic calendar globally with data that could provide more clues about how these big themes are playing out.
Absolutely. And the material we looked at, it repeatedly brings us back to this core theme of uncertainty, whether it's about getting a handle on precise population numbers in real time, or understanding the complex real-world impacts of trade policy shifts, or predicting the exact path for monetary policy. It really suggests that while forecasts are, useful guides, the ability to interpret incoming data and remain adaptable to surprises is perhaps more crucial than ever for making sense of the current economic landscape. So keep a close eye on how these data points land this week, especially in light of the dynamics and uncertainties we've discussed. And maybe something for you, the listener, to think about. Considering all that uncertainty we talked about, particularly around how global trade issues might actually manifest in the numbers, what single piece of data are you going to be watching this week that could potentially offer the biggest genuine surprise to economists and policymakers? What will you be keeping an eye on?